I published a new blog post earlier today, November 15, 2025, discussing my trades over the past few days. A link to my blog post, which I have published starting in October 2008, can be found in my profile page here at YouTube. The stock jocks experienced some anxiety late last week, but nothing that would require them to breathe into a paper bag to relieve the symptoms. The two major concerns appear to be AI stock valuations and a Federal Reserve possibly being more stingy with interest rate cuts, at least until more inflation data becomes available that relieves their current concerns about inflation moving higher. The CME FedWatch tool currently has the odds of a 25 basis point cut in the federal funds range at the December meeting at 44.4% probability, down from 66.9% 1 week ago. The significant percentage decline in Bitcoin, which had a high of over $125,000 in early October and went down below $95,000 last week, and other cryptocurrency declines as well may be contributing to some stock selling or at least a loss in risk appetite among many investors. In today's blog post, I discussed buying $50,000 in principal amount of Treasury bills at last week's auctions, slightly more than $1,812 invested in dividend-paying stocks, $511 in U.S. equity preferred stocks. I prefer buying Canadian reset equity preferred stocks on the Toronto Exchange, as I explained in today's post. $537 in an exchange-traded first mortgage bond issued by Energy Louisiana, and two corporate bonds, my first purchase in several months, and it was a borderline purchase at that. I had 45 corporate bonds mature today, scattered over 3 accounts, and all of the proceeds received in my Fidelity account today, which was $30,000 in principal amount, will be used to buy Treasury bills at the auctions next week. The remaining $15,000 that proceeds received in my Vanguard and Interactive Brokers account will be either redirected into other asset categories like stocks, which I have been purchasing more of in my Schwab account, or allowed to remain in my sweep accounts at Vanguard and Interactive Brokers. The main reason for buying more dividend-paying stocks, preferred stocks, and some bonds is a recognition that my T-bills, a significant allocation for me, will generate less interest income in 2026 than in 2025. I am close to 100% certain that will be the case, maybe 100%. So I am attempting to replace some of that anticipated lower interest income in 2026 through starting now purchasing dividend-paying stocks primarily, with most of the purchases having dividend yields in excess of 4% and many over 6%. Based on what I've been doing for the last few weeks and adding, being a net buyer of dividend-paying stocks, and assuming that I continue on that path for a year every week, I will have added somewhere in the $5,000 to $7,000 in additional annual stock dividend income after 52 weeks. The amount will depend on whether I am mostly buying in the 15 to 2,000 range or reverting more back to closer to $1,000 per week in purchases. I am finding it difficult to buy even the beaten down stocks now. I am uncomfortable about the stock market at the current levels. I did note that in today's blog that Trump had reduced tariffs on certain products late Friday, including beef, coffee, bananas, and certain fruits that are not grown in very large quantities in the United States. To me, that is a clear recognition that the Republican tariff taxes were increasing prices in those food and beverage categories, which was obvious. The tariffs are not paid by foreign countries, as Trump claimed many times, and received cheers from his supporters when he made those claims during his campaign. The claim that the Trump administration is making is that they are trying to fulfill his campaign promise to reduce prices by lowering the tariffs on some of those products. And that is a misleading claim that they're very good at. What he is doing is lowering part of the price increase that he has caused due to the Republican tariff taxes that he imposed by executive fiat. Even the reductions may not be passed through, since many U.S. companies did not raise prices to recoup 100% of the Republican tariff taxes that Trump had made them pay. Based on what I've read so far, this is another reason why prices will not come down much, if at all. The 50% tariff on Brazil's products was reduced by only 10%, so I will be still paying more for coffee and hamburgers because Trump wishes to punish Brazil for criminally charging and convicting Trump's buddy, the former president, for attempting a coup after losing the 2022 election. And some of us still wonder why the United States president is raising prices for U.S. consumers because he's unhappy with an internal development in Brazil. The government will start to publish data that will most likely poke some holes in the blue sky economic scenario that is baked in the current stock prices, or at least the prices for the stocks that have been responsible for the rise in the stock market. That would include the AI stocks. The data I expect when it starts to be published will confirm what I believe is an ongoing early stage stagflation in the United States, marked by declining or barely positive month-to-month job growth, and certainly not enough job growth to meet the demand from new entrants into the workforce, and a continued uptick in inflation that can reasonably be predicted to continue as more tariff taxes paid by U.S. importers are incorporated into consumer prices and more serious disruptions occur in the U.S. supply chains, caused in part by the Republican tariff taxes and mass deportation of workers who fill important roles in the supply chain, particularly in agriculture, food processing, construction, and small-scale manufacturing. And it will take time for all of those problems to become fully reflected in price increases.